Imagine being able to pinpoint the exact turning point of any trending market. Imagine being able to ride that change of trend all the way to the reversal in the other direction. It would certainly be an incredible event that would no doubt make you a lot of money. The reality is, though, that you can't do it with any consistency, and those times that you do nail the turn, trust it was probably luck. Many people still try to attempt it, though, and you can try by limiting your risk. Now, there's an obvious point where you know you're wrong, and that's where the stop would go. Those losses will add up, though, and the death from 1,000 cuts will bleed your account dry. Now, patience in trading, it's often talked about, and after a recent conversation with someone entering the trading world, I want to put an example together on how I look at patience. Now, I'm going to use Forex as an example because I much prefer to swing this market, use higher time frames to do so, and this pair was brought up to me by a trader. Unlike intraday trading, swing trading is an arena where you must exercise patience, or you may catch yourself going the wrong way in the face of a trending market. Now, in a swing trade, I look to capture a clean swing in a trending market. Markets move in impulse corrective patterns, and an intact trend will have the impulse move larger than the corrective move. As well, if in a counter-trend play, it abruptly ends to the correction, especially with a large influx of buying and selling pressure, may not give you enough notice to reduce risk or take profits. In reversals of trends, rarely will we get a V-shaped turnover, as many trends end with a consolidation period. Seeing this formation and the details on lower time frames can give you hints as to the intention of the big money. Now, here's a portion of the daily chart of the US dollar Japanese yen. After many months of consolidation, this pair broke the high of 2013 in September 2014 and hit the high in December. The pullback is the largest pullback in price, but not time, since the breakout. It's obvious that after such a long run up, there's people looking to short the first opportunity. Not the cleanest of pullbacks, which should alert you to the possibility that a reversal of trend may not be in the cards. You can see where there was an attempted violation of an area that supported price, and price was rejected back in the direction of the trend for about 500 pips. Those that were looking for a reversal at the next day put in a rally of 200 pips. You can imagine that those shorts had to take action to protect themselves. As an intraday player, though, there were probably some good opportunities depending on how you approach your day plays and which trend you decide to trade. While this bounce may have been an opportunity for intraday players or shorter-term swing traders, I look at higher time frames. Now, this is a portion of the weekly chart in the same date range which showed the bounce. If not already long on the daily, what does this weekly show you? There's decent strength in the buying pressure. The attempt to drive price lower was sharply rejected. Does it give you any indication that the uptrend is in danger? No. So which direction has the highest probability of not only seeing the resolution, but also a larger move? The uptrend. So let's head to a chat I had with the trader that actually prompted what I'm talking about. This trader had positioned himself long in the direction of the weekly by playing a move after the bounce. He bought a pullback after the bounce around 117 by dialing into the 60-minute chart. The issue he is having is that price has gone into a range after he scaled out, and he's wondering if he should position himself short. Now, I am not one to tell anybody what to do with their position, and maybe shorting is the right play. But this is what I see on the weekly. Price is taking a breather and working off that upside move. Price will coil and break to the upside, and also a multi-week strong run-up in price. That would be my working plan and would look for patterns to get me into the pending move off the daily chart if I traded this pair. However, in trading, you have to be ready to go with the flow. Number one, it's not beyond reason that price could rocket to the downside and never look back. Number two, we could also see price break to the upside out of this pattern and then be overtaken by selling pressure. This would obviously have me curbing any sort of position to the upside in this market. For now, patience in allowing what was a trending market direction to continue is needed if this was my plan. Now, many traders will not sit and wait for whichever market to show its hand, but instead will rely on assumptions to get them into the market against the trend. Now, assumptions usually don't work out in your favor, Big run up would equal overbought and prime for reversal, short. Too long in consolidation, which equals lack of buying pressure, short. Price divergence would equal reversing move, short. I have found patience was one of the hardest things I've had to accomplish in trading. Not just in entering trades, but also holding trades that have not been invalidated but are just not moving. Swing trading, though, demands patience, and patience pays off when you let the market tip its hand and you just go along for the ride. Now, to end, here is another part of the weekly chart from the middle of 2013. Price had rallied from September 12th at 77.12 and capped in May 2013 at 103.72. B, price broke to the downside, 93.76, and then formed the same pattern as we see now. C, price broke to the upside and capped at 121.84, where we find ourselves now. Is a swing trade short really in the cards right now, or is history going to repeat itself? Have patience and let the market show the way.